Imagine this. You've got $10,000 sitting in your checking account, earning next to nothing. Inflation is eating away at it like a hidden tax, and you're losing money every single day without even realizing it. Now, what if I told you that just by moving that cash into the right financial tool, you could be earning hundreds, even thousands more per year with almost zero extra effort? The problem? Most Americans don't know where to park their money in 2025, ETFs, CDs, or high-yield savings, and it's costing them big time. They see the headlines, they hear the conflicting advice, and they end up paralyzed, sticking with the same old checking account that's making the banks rich, not them. Stick around, because today we're breaking down exactly how to make your money work smarter for you, based on your goals, your risk tolerance, and the latest 2025 financial landscape. We're talking real numbers, real strategies, and real talk about how to come out ahead no matter what the market throws at you. Let's start with the simplest option, high-yield savings accounts, HYSAs. These are like your traditional savings accounts' high-performing cousin, offering interest rates that can be 10 times higher than what big banks like Chase or Bank of America pay. I'm talking about actually earning something on your money, not just watching it get eaten away by inflation. Right now, in early 2025, the top YSAs are offering between 4.5% to 5.5% APY. That's thanks to the Fed's rate hikes over the past few years. But here's the kicker, that rate isn't locked in. If the Fed cuts rates later this year, as many analysts predict, your HYSA yield could drop. Now, you might be thinking, why would I choose this over a CD with a fixed rate? Two magic words, liquidity and safety. Unlike CDs, your money isn't locked up, you can withdraw anytime without penalties. Need to tap into your savings for an unexpected expense? No problem. And unlike ETFs, there's zero risk to your principal. That's right, the money you put in is the money you get back, plus the interest. That makes YSAs perfect for your emergency fund, short-term savings goals like a down payment in the next 1 to 2 years, or cash you might need quick access to. But, and this is crucial, not all YSAs are created equal. Many big-name banks still offer pathetic rates below 1%. I'm talking about you, Bank of America. You're literally leaving money on the table. You've got to shop around at online banks like Ally, Marcus, or Discover. These guys have lower overhead and pass those savings on to you in the form of higher interest rates. And remember, the FDIC insures these accounts up to $250,000, so even if the bank fails, your money is 100% safe. That's peace of mind you won't get with riskier investments. Certificates of deposit or CDs are like a financial handshake with your bank. You agree to lock up your money for a set term, say 6 months to 5 years. And in return, they guarantee you a fixed interest rate. It's like saying, hey bank, I'm giving you my money for a while, so you better give me a good return for it. In early 2025, top CD rates are hovering between 5% to 5.8% for one-year terms, which is pretty attractive compared to historical averages. We're talking about beating inflation, and then some, folks. Here's where CDs shine: zero market risk. Even if the stock market crashes or rates plummet, your APY stays the same. That predictability makes CDs ideal for medium-term goals. Maybe you're saving for a car in 18 months or a home renovation in 3 years. You know exactly how much you'll have when you need it. But, and this is a big but, early withdrawal penalties can be brutal. We're talking about losing months of interest, wiping out your gains and then some. It's like getting penalized for needing your own money. There's also a strategic move most people miss: CD laddering. It's like diversifying your CDs, folks. Instead of dumping all your cash into one 5-year CD, you split it into multiple CDs with staggered maturity dates. For example, 1 year, 2 year, 3 year. This way, you're not locked into a single rate, and you've got money freeing up regularly to reinvest if rates climb. It's like having your cake and eating it too. You get the security of a fixed rate, but with more flexibility. One legal note: CD interest is taxed as ordinary income, just like your HYSA earnings. So if you're in the 24% tax bracket, that 5.5% CD is really more like 4.18% after taxes. That's why for long-term wealth building, we've got to talk about ETFs. Exchange-traded funds, or ETFs, are where the real wealth building happens, but only if you use them strategically. Unlike CDs or high-yield savings accounts, ETFs let you invest in hundreds or even thousands of stocks or bonds with a single purchase. It's like owning a tiny piece of the entire stock market. The S&P 500, for example, has historically returned about 10% annually over long periods. That means if you invested $10,000 and left it alone for 10 years, you could realistically have $25,000 or more thanks to compounding, versus maybe $16,000 in a 5% CD. That's the power of the market, folks. But, and this is critical, ETFs come with volatility risk. In the short term, your investment could drop 20%, 30% or more during a market crash. That's the price you pay for the potential for higher returns. That's why they're best for long-term goals like retirement or wealth building, where you won't need the money for 5 or more years. We're talking about riding out the dips and coming out ahead in the long run. Here's a pro move most beginners miss. Not all ETFs are created equal. A total stock market ETF like VTI spreads your risk across the entire US economy, while a sector-specific ETF like tech or energy can be far riskier. There are also bond ETFs for stability, dividend ETFs for income, and even treasury ETFs that act like CDs but with more flexibility. It's all about finding the right tool for the job, folks. Tax-wise, ETFs are more efficient than CDs or high-yield savings accounts. Long-term capital gains for holdings over 1 year are taxed at just 0%, 15%, or 20% depending on your income, way better than ordinary income rates. Plus, you can hold them in tax-advantaged accounts like IRAs or 401(k)s for even bigger savings. It's like getting a bonus from the government for investing wisely. Okay, let's get tactical. Where should you park your money in 2025? Here's the cheat sheet based on your goals. Emergency fund or cash needed within 1 to 2 years, high-yield savings account, safety and liquidity, that's the name of the game. You need that money accessible and earning a decent return while it's sitting there. Medium-term goal, 2 to 5 years, and hate risk? CDs or CD laddering. Lock in that rate, know exactly how much you'll have, and sleep soundly at night knowing your money is safe and sound. Long-term growth, 5 or more years, and can handle the ups and downs, ETFs. This is where you tap into the real power of the market and let your money grow exponentially over time. But here's a curveball. You don't have to pick just one. Smart investors blend these tools, keeping emergency cash in a high-yield savings account, medium-term savings in CDs, and long-term money in ETFs. That's how you optimize safety, growth, and liquidity all at once. It's like building a diversified portfolio, but for your cash. You're not putting all your eggs in one basket, you're spreading the risk and maximizing your returns. Remember folks, this isn't about getting rich quick. It's about making smart, strategic decisions with your money so you can achieve your financial goals. Whether it's buying a house, retiring early, or just having peace of mind knowing your finances are in order, it all starts with knowing where to park your cash. So take action today. Don't let your money sit idle in a low-yield account. Put it to work for you and start building the financial future you deserve. So, where should you park your money in 2025? The answer depends entirely on your timeline, risk tolerance, and goals. But one thing's certain, letting cash rot in a 0.01% checking account is a silent wealth killer. That's money you're losing every single day that could be working harder for you. If you got value from this deep dive, smash that like button. It helps more people find this info. And drop a comment below. Are you team high-yield savings account, CD, or ETF? I'll reply to as many as I can. Let's get a conversation going and help each other out. Want the exact banks and ETFs I recommend right now?